Hello, Warriors. Alexander, Rock, Hugo, Ingmar, everyone doing okay? I hear somebody anyway. Hey, Ryan, how are you?
Yeah, hi, Coach. How you doing? You all right?
Huh?
Can you hear me okay?
I can hear you. How are you?
Yeah, not too bad, mate. Yourself?
Good. I'm doing fine. Good morning, Marco. Ryan, Sa. Okay, so pre-Fed right here. Fed 2-day meeting, Ryan, like usual.
Yeah, it all kicks off.
Okay. So they tried to take the euro back down, putting in a higher low. Are people front running the Fed? Because, I'd say 90% of the market is expecting him to be sanguine and dovish. Maybe he'll cite Delta. So I would think that if anything, Ryan, that people try and front run a Fed dovish stance, and they're probably selling the dollar in anticipation of it. The only difference is today the euro's a little bit stronger than cable, but cable's acting okay and the yen's under pressure. So what are your thoughts going into
we've got a new theme today. We've been talking about goldfish markets and the thinking changes every 5 minutes. Well, the theme today is apparently the stagflation fears kicking up, or at least growth worries. Two real things in happening today. We've had another big sell-off in Asia, in China.
Yeah.
And there's been some rumours around that the US are going to put restrictions on US people owning, Chinese assets and whatnot. That sort of morphed into potentially a rumor of a blanket sell-off in China assets by US traders. I think that's a little overblown, but it seems to have shaken the market up on that side of things. I think potentially maybe all we'll get is a couple more entity or people sanctions from the US. I can't see the US suddenly turning around and telling everyone you can't hold Chinese assets, because that'll just kick off big time. But you know what the market's like, and it's spooked it in Asia at least. And the second theme is these growth worries or stagflation worries that are coming up in the platform in the room. We've been looking at the bond moves, and tips are really seeing a lot of activity. 10-year tips, all the tips are seeing a lot of activity. Obviously, tips are inflation protected bonds, which is where you go.
I don't think we're going to see this low again, Ryan. I think last week was pretty important regarding rates, no matter what the Fed says, that when you look at a weekly candle like this, if we can just get a little follow through, this may be the low before we make new highs in yield sometime this summer before the fall. So, I mean,
I agree.
That's my take on it. So, yes, go ahead.
Do you want me to see if I can just share my screen quickly?
Sure, yeah, that'd be great. Yeah.
Let me just do it quickly.
I'll stop sharing. There you are.
Okay, let's give this a go, see if this works.
I think you can do it, Ryan. You have a little bit of experience in screen sharing, I think. And everything else related to the business. So
yeah. So can you see that okay? It's a side by side.
All I see is a blank screen right now. So
yeah, same here. I see a black screen.
That's all we need.
How you feeling, Stel?
I'm almost back to 100%.
Yeah,
I sound a bit weird, don't I?
No.
Oh no, I always sound
great, man. Anytime I hear your voice, it's great.
I love you, bro.
All right. So now Stelios is up there. So did you, Ryan? Did you click the green box on share screen?
Yeah, it's asking me which page I want to share.
Oh yeah.
How's that?
Nope.
Not yet.
It shows your screen sharing, but all we have is a blank screen. So you're not clicking on the right screen. How many screens do you have? Do you have a spaceship?
Yeah, I've got two. I've got
Two?
two, and I'm
Okay.
clicking. Yeah. So let's try that on Chrome tab. How's that? Anything?
It's the same. Okay, we'll
Same.
figure it out eventually. Don't worry.
Yeah, that'll be a work in progress. Anyway, to the point at hand is we're looking at the 10-year tips versus 10-year nominals, and real rates are really in a negative, and the tips is somewhere where folks will go when there's strong inflation to protect their returns, and we're seeing a lot of activity in the tips. It's broken below the lows that it saw over the the virus wobbles, whereas 10-year yields are still way above those lows.
What's a symbol for the tips, Ryan?
I don't think there's one on TradingView. I've tried
Okay.
looking for it, so I've had to go elsewhere. But it's something like minus 1.13% at the moment.
Okay.
And the prior lows were, let's have a look. The prior lows were just above that, around sort of minus 1.1%, going back into sort of Q3 2020. So really, if we are seeing these growth worries, I think there's a bit of positioning going on that perhaps isn't justified, but you know what the market's like, you know what risk takers are like. If they see a problem coming, they're going to position for it. And we're having a bit of a discussion in the room at the moment as to how far that's going.
So they go into the big tech, Amazon, to the FANG stocks in a situation like this that did well during the shutdown, during the lockdowns, and avoiding cyclicals because of that, or value.
Yeah, I don't know if we're seeing that, because this is the weird thing. We're seeing these moves in bonds, but FX is largely not doing much. I mean, look at the move the last week or so when 10s dropped, minus 1 point down to under 1.5%, whatever it was. Yeah, exactly. And FX barely budged really, and I think that's the same we're seeing in other assets. I mean, obviously, if you've got stagflation worries, it's a toss-up between, is the Fed going to act on inflation or act on the economy? And if it's going to look through inflation, act on the economy, then it's going to stay dovish, and then that's obviously supportive for stocks. But I think whether again this is one of these moves that this is the explanation for today and tomorrow it's something different, I don't know. But we know that the move in bonds has been a bit more long-lasting now, among the other things.
Okay.
So yeah, I think we've just, unfortunately, we got to sit on this until we get over the FOMC. I think he's going to potentially talk more about jobs as that part of the mandate. He did that in the testimony. I don't know if you recall, he mentioned that quite strongly, the jobs market, because it's easy for everyone to talk about inflation and forget that jobs is another part of their mandate, or the other part of their mandate.
Yeah.
I think Powell's going to be heavy on the jobs aspect as a way of doing a bit of deflection off the inflation talk. But I think it's all going to be a can kick until September, and we see these job support schemes running off, and then we get a better taste of what the jobs market's going to look like.
Okay. Any view on the metals? I mean, they're trying major support. Look how many times you've been able to buy gold off this support level. 1, 2, 3, a little spike, 4, and now here we are 5. So they're giving gold bulls a lot of time and opportunities to get long against the 1794 level. My concept is markets usually don't accommodate people that long. If this was a big level, why is Mr. Market saying, oh, you missed it here, but you could do it here? Oh, okay, I'll give you a few more days, maybe a few more attempts. So, they're making this level look good. If we stay under 1810 after the Fed, I think that could be negative gold. Over 1810, I think they have a chance to run this thing. And silver looks more and more like a bear flag. So, even when the dollar's weak, we're not getting much lift out of the precious metals, is what I've noticed. Yeah,
I agree. I think particularly with gold, it's almost a similar situation to euro dollar. It's a pretty much a
Yeah.
similar pattern. You know, we're
Yeah.
not getting those higher highs, we're getting lower highs, and you know, we've got
Compressing.
that big level. We've got that big level down there, and you know what happens if you knock on the door too many times. At some point, it's going to open, and depending on how many times you knock, is potentially how deeper push through you're going to get. So it may be worth, you know, gold especially, same as the euro, around that 1750 area. You know, if you're looking to trade it, if you've been buying off the level, maybe it's worth sticking a reverse stop just underneath it to try and catch a break. But you know, be very tight.
Do you use them, Ryan? Because I've talked to people, you know, that I teach about reverse stops. It's a hard thing to do if you don't have the order in, to take a loss and then turn around and reverse out. But if you have a reverse stop in, it's automatic. You don't think about it. And there are so many opportunities where the market's good or bad from there, and where you have your stop, if it gets through, the market could run. So why not go with it?
I regularly use sell stops or buy stops or reversal trades against big levels, because if you know a level's big, I mean, you know, look at that gold level. You know, it's going back all the way into June. It's a big level. You know, where you park though is the issue. You know, do you go down as far as that 90 level? So maybe you go in at 88 or 85. You know, you're giving it a bit of room, because we had those little spikes below, and you don't want to get flipped out two ways. But yeah, if you keep it tight, so it's a way of catching a move if it happens. And if you get a runner, well, fine, and you're sitting on it. But you can also keep it tight, so it may mean you lose two trades on the trot, fairly tight. You lose on the long that you had originally, and you lose on the stop. But that's the same for every trade. But I always weigh how big a level is before I commit to a reverse stop.
And good morning, Ryan and Dale, and I heard Stelios back there too. You know, and I have to echo Ryan's sentiment. I don't use a reverse stop unless it is a big level. Like you know, if you're sitting there going, man, I know that if the S&P broke below 4,200, like no matter what, that's like that's going to be that's a number that I want to be short at. Then I might, you know, or something, you know, just some example like that. It has to be a really, really, really key level.
Show that level, bro.
Huh?
Show it.
Oh no, I was just throwing that out there. Just it wasn't anything. I'll show my chart. It doesn't really matter, because that wasn't necessarily what I was saying, that just to say it as an example. But I completely agree with what Ryan was just saying. So,
but the other thing also, you know, with trading breaks and catching breaks like that, you know, if you start getting into, I think it's going to break this level, then you could potentially end up getting, you know, mugged off because you're short 5 pips above it and it doesn't break and you get stopped. But if you feel that strongly that level is going to break, there's two ways you can play it. You can go with a sell stop, which takes the emotion out of it because you got an order in, or you wait for the break and you look for a confirmation. So let's say gold breaks down to 1780, bounces back to that sort of 1800 night level, holds, doesn't break above it. That's when you got some conviction to enter in a short if you weren't in one before, because you've had the confirmation that level's broken, and then you know, chances are that it's going to head lower again after finding support there. We've got exactly the same case in the Aussie dollar. You know, 74 was a big level. We broke it and we've come back up, tested it. It's held like perfectly. And so if you're in shorts, then you're sitting pretty.
Yeah, and the flip side of that is, you know, if it breaks back above 74, you know, it's a pretty big level. There, like I'm looking at the dollar CAD. I you know, if you're like sitting here thinking, oh man, I want to short it, you know, I think, you know, you look at this support, it's held for the last several days right here at 125.30. You can see it right through here. It's channel support. It's right there. You know, if you want to really be short, just wait for that level to break, and then, you know, get short, put in a 20 pip stop, look for a 40 pip gain, and, you know, that's it. You know, call it a day. You know, and you can find really key levels of confluence that are supporting or capping an asset whatever you're trading, and then just trade like that. There's nothing that says that you can't do that.
Yeah, and you take, as we spoke about yesterday, you're taking out the I think part of trading,
Yeah.
which is good to know. One, you let the levels do the talking, let the price do the talking. If
Right.
it breaks, if the level breaks, you go with it, and you stick your stop just above it, and that's it.
Yep.
Trading's trading, and you're not thinking about it. You let the market do the job for you.
Yeah, and but what do we all do in the markets? We all tend to overthink a little bit, don't we?
Yeah, of course. We have nothing to do otherwise.
Especially once you've been around for a long time, you're like, oh, I know what's going to happen, and I know their game here. Speaking of which, let's talk a little bit about the markets got a little shook up. You were talking about the Asian markets overnight, and just to highlight it, just to show you guys a little bit. If you look at Shanghai, we actually cracked through that support. We were looking at this trend line support yesterday, broke through it. The Hang Seng also broke down through some trend line supports here. You can see how we broke that. Now, one of the byproducts of that has been a spike up in the US dollar CNH, and you see the US dollar CNH broke through, speaking of a level, broke through some resistance here, but it also cleared the 200-day moving average as well. And I think this is worth noting, because if you are following the US dollar CNH, we've had a huge sell-off, really big, double top, completed the double top from, back in the 2020 timeframe. This is a good example, and this is a managed float too, so just keep that in mind. We have this false breakdown here. You can see the screen line, right? False breakdown, and we've been very well supported, and then all of a sudden, here we go out of nowhere, just start breaking out to the upside. And I would keep an eye on this US dollar CNH. If you guys are, especially those of you that are trading in Asia and probably in Europe as well, because if we start surging back through new highs, like let's say tonight in Asia, and we take out these highs from today, then there's probably going to be some risk off following that, as well. Does it make sense? And by the way, how do you read, Ryan? I'm just going to ask you while you're here, and Stelios, if you want to chime in here in a moment. But what do you make of the US dollar CNH move higher overnight, if anything?
Yeah, it's 650 has been a key level all the way up and down, up and down, up and down. So it's always something you got to keep an eye on. Again, it's one of these things. Are these moves going to follow through? Is this the start of a bit of a trend in a sell-off in Asia, China, or are we getting another one of these quick blowouts and everything's right as rain tomorrow? But the 650 is something to look at. I meant to look at it earlier this morning, but I never got round to it. I'll be looking at potentially buying into that 650 if we get a test. There's no need to fuss around, maybe 648, 47 stop, something like that, and just see if it continues. Obviously, the risk is that everything's going to happen overnight when I'm tucked up with Teddy. But,
yeah.
That's the markets for you.
Right. And then we do, obviously we have as we've been talking about, we have the Fed tomorrow, which, it's going to be, I think a lot of people are obviously waiting for the Fed, but you're going to get some position adjustments ahead of the FOMC. And that's what that could possibly be some of it today. Sorry, I don't mean to have the yawns this morning. It was one of those nights, and you guys probably know those nights where you lay down and go to bed, and usually you fall asleep quickly. And I think I rolled around for a good hour or two before I actually fell asleep. So I'm yawning this morning. No, Stelios, we haven't heard from you as far as the US dollar CNH goes. What are your thoughts here with the CNH? Should we read any further into it, or is it just something you're just kind of like, yeah, whatever?
I think as with most markets, this is just short-term moves. The market have very short-term horizons at the moment. What I'm looking at is just
Wait, Ryan, what did you call the market?
fish. What was
Goldfish.
it?
Goldfish.
Goldfish. Yeah.
Goldfish market.
Yeah. There you
Flush
go.
that goldfish down the toilet.
Yeah, unfortunately, I think that's how it is. And if you look at the past few months of trading, there's no clear direction. The thing that's going to drive everything is central banks. I mean, they have been the ones who have brought us here. They're going to be the ones who take us back if they do. So I think they, until we get some clear view or clear direction from the Fed, from the ECB, I think moves are going to be short-lived and with no follow through. Now, what I wanted to say about the FOMC tomorrow is that theoretically, right, the Fed has every reason to start to start tightening policy because, you know, anyway you look at it, higher inflation, wage growth is going higher as well. We're recovering from the COVID massacre, you know, if you want to call a 3-week move a massacre. But anyway, we're recovering and countries are opening up. Yes, there's a Delta variant and all that, but you can see in quite a few countries who are vaccinated well, the death rates are going down. So theoretically, if you're not going to be tightening now, what are you actually waiting for? That's my thinking, and I really cannot believe that they are still, you know, giving us this hugely accommodative monetary policy. Now, of course, we're talking about the Fed, and we're talking about the Bank of England and the ECB, and they always want to be on the dovish side, or they seem to prefer to be on the dovish side. Otherwise, they would have already done something. So, so the market now is kind of in denial until we get the move that says, okay, we're starting. So, you know, that's why I'm starting to fear FOMC meetings like tomorrow, that at some point the market is going to get spooked and they're going to realize that, okay, it's starting. So I think that I'm actually going to go short bonds into it. I'm probably going to buy TBT or TBF or some one of those ETFs as for a short-term trade, because I think the risk is starting to become more pronounced for the market to actually get spooked and realize, oh damn, you know, 10-year US below 130. This is insane. So that's what I'll be doing. I think I'm going to get short today and carry it through tomorrow. And if it works, great.
Yeah.
If it doesn't,
well, you know, and if you guys are thinking like along the same lines as Stelios, one of the ways you can express that in the currency market is just get long dollars. So that because that would be the equivalent of thinking along the lines of more hawkish Fed. And if you look at the dollar index, just FYI, I'm gonna take a step back and go into a daily chart of the dollar index. As you can see, we are really very well supported. Now we've shook off the ECB meeting from last week, and we didn't break out. And matter of fact, if you look at the euro right now, we're still in that damn wedge. We're trying to break higher out of the wedge right now, but we were also trying higher yesterday, and then we slumped back into the wedge. But more importantly, if you look at the dollar index, we're just kind of holding up against some pretty key resistance. So going into tomorrow, if you're like in you know the same attitude that Stelios has, you're like they've got to start, you know, becoming more hawkish and remove some of this accommodative policy. You know, the dollar index has held up very well, and you know, for me, I'm looking for a break above 93.25, because then, you know, we talked a little bit about trading stops and seeing a more pronounced move through a resistance. You know, I think that a move right through here, you go through 93, you know, 93.25, we should make a move to 94.5 pretty easily. I think this is, you know, once we start squeezing past here, it does open up the door for a lot higher levels in the dollar index. But we are at channel support, and so risk reward would be, you know, hey, this is probably the better risk reward to be on the long side of the dollar if that's the trade you want to take. So Ryan, what's your opinion regarding, you know, what Stelios is saying, like as far as, you know, what the Fed's got to do? And I'll tell you, and one of the things that I do agree with and I don't disagree with Stelios at all, but one of the things that I always think about is the Fed does want to put themselves in a situation to combat any further risks that they might encounter in the market. They don't like to have monetary policy at zero. They don't like to be down here at zero bound. They want to be dovish. Of course, they want to support the markets, but they also have to, reload their gun, if you will, after expending as many bullets as they have. So they do want to be in a better position to deal with a crisis type of situation as they had to, just a year ago. So what do you think, Ryan?
Yeah, I think, as I mentioned yesterday, and I agree with what Stelios is saying 100%. I think it's possibly more a case that the Fed, they don't want to be more dovish, but they want to keep those expectations low. They don't want the market go running on the other side, on the hawkish side. It's all about keeping those expectations down rather than continually being hawkish dovish in policy, if you know what I mean. But it amounts to the same thing. But he's 100% right. I mean, when this virus thing happened, the central banks, they took their lessons from the GFC and they threw the kitchen sink at it. They didn't blink. Bang, QE, more QE, ECB with their PEPs, bang, 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 hit it now, and then we worry about it after. Because that's what they designed all those tools for. So they stood there and went, yep, hey, look, we've got the tools, we're going to use them. But what I think the rut they're now stuck in is that you could say that potentially maybe 20, 30, 40% of what they've done, QE, PEP, stuff like that, is emergency stuff. That there's emergency measures in there. And I think that's the part that could be withdrawn now. You can still keep QE going. I mean, let's say the Fed had PEP as well as QE. I think they would have stopped that, 2-3 months ago. Because they saw the economy recovering. Yeah, there's still risk, but they can say, right, we can pull back some of that emergency measure. We'll keep QE going. That's going to be the longer term support, but we can dial back on the emergency stuff. We don't have to be, balls deep in this anymore. But obviously they haven't got.
Did you say balls deep?
I was about to say that.
This is a family show, and I really do not think you should be talking like that.
Nuts deep? Is that better? Nuts deep? I don't. or am I digging myself a bigger hole?
No, I'm just harassing you.
But yeah.
Dale curses all the time.
So I've heard.
Bullshit.
He's hey. Anyway, no, I'm just harassing you.
But yeah, I think
trying to get some people to
some of these central banks need to pull some of this emergency stuff back and then take it from there. The taper's not going to be a big. If the Fed turn around tomorrow and said we're going to taper 10 million a month, it'll take them 15 months to get down to zero. It's plenty of time.
Yeah,
I mean that's
true. Yeah, very true. Very true. And the fact of the matter is we are extremely accommodative. And if you look at, obviously if you look at equities, I mean, the move has been crazy. I cannot believe literally just about a year ago, we were just sitting here and the S&P was, below 2,500 roughly, well, I guess just over a year ago, we were just where we were at. It's been an amazing move, and it's all fabricated due to central banks, and they've got a lot of cushion here. Is if they were ever worried about equity markets, I know it's more of a byproduct, but if they're ever worried about equity markets, I mean the amount of the amount of gains that we've seen has been extraordinary, obviously. So, but I want to mention this just before we go. I do have to admit the dollar is holding up very well. Despite where we're at in equities, and that's very surprising to me. What's actually more surprising, it's not so much the dollar. I tell people this, and really, if you ever want to see the dollar catch a risk off type of bid, you really have to see stocks or risk assets correct, more than 15%. And then the dollar really gets up and goes. I don't know if the dollar would necessarily strengthen too much if we saw some risk off. But what's most surprising than anything is these commodity currencies have not rallied. They still trade very heavy, like the Aussies below 74 cents, as Ryan pointed out, the Kiwis below 70 cents, big rejection at resistance. The dollar CADs looks like it's done going down. It couldn't break back below 120 after we've seen the S&P basically double from the lows. And we've seen commodity prices rip the way that they've ripped. You still have these, even emerging market currencies like the dollar MEX, it's been done going down for like all of 2021. I mean, this is not the currency market responding well to stocks at all-time highs. Anyway, I just needed to bring that up. And guys, you hear Ryan, Stelios, myself, Dale, you want to chat with us all day, be part of the ForexAnalytix family. Right now, Forex Flow Live, as most of you know, is in process of merging with the ForexAnalytix family, and as a result, we are offering a discounted price. We haven't offered a discount since the beginning of the year. It's buy 1 month, get 1 month free on a month-to-month basis for those of you that want to be on a monthly plan. Those of you that have been around for a while, if you want to take advantage of the discounted amount, we have the semi-annual and annual plans heavily discounted to celebrate really the merger of ForexAnalytix and Forex Flow. So thanks everybody for tuning in. Dale, have a great interview. Stelios, Ryan, thank you guys for all your comments today.
Guys,
Everybody.
See you, Ryan, Stel.
Cheers.
Have a great trading day, guys.
What's up?
James, welcome back to F.A.C.E. How are you?
Make sure I'm unmuted. Can you hear me?
Yeah, you're good. Got your photo up here, James. Welcome back.
Thanks for having me again. Always a pleasure talking with you.
Okay, so are you going to share your screen?
Yeah.
Anything you want to show
Let me see what
today? I'm interested. I know you're a sound, hard money guy, and with the Fed coming up in the next couple days, and gold seems to be respecting this 1794-95 level multiple times over the last several weeks. What's your read on gold going into the Fed?
After the last time the Fed came out, obviously gold got hammered pretty well. It's shown strength of late, but there is some downside risk. I don't think it's huge. I don't think it's going to be anything. Sorry about all these dings. I need to turn off this this
Okay.
iMessage thing. 1 second.
All right.
All right. I'm first and foremost, I'm not a day trader. This is not what I do. I'm much more of a medium long-term speculator in this.
Okay. So then let's talk. Let's go there then.
Let me share my screen so I can give you guys a little bit of.
Okay. It's a green box, buddy.
Green box. 1 second.
Yeah. Share a screen. Green box.
Yeah. Then it gives me all these damn options. Desktop.
Yeah. Choose the screen you want.
Share. Oh God. Got grant access. Just 1 sec, Dale. Sorry about that.
Okay. It's okay. I'm guessing you're probably going to want to talk about Basil.
You know what?
No.
A little bit. Everybody had this it was so hyped up that was going to make an actual change in the short term, and that's so foolish.
Yeah.
Obviously, that the London portion of that was not supposed to start until Q1 2022, and to be honest, that's where mostly unallocated gold and silver is getting traded, is in London, not in Europe. So, some in Switzerland, but there's still people who think that that's going to have an effect. I think it's remaining to be seen. What's going to have more of an effect is doubling the monetary base in almost like 2 years' time. But eventually, that's going to have a real effect. There's a lot of people who think, oh well, it's just like 2008. It'll just stay in the banking system. I'm not sure that's true, given the longer term goals. I think of where we are. We're in a situation in the next 20 years where we have a pile of promises and unfunded liabilities that cannot be nominally met if we continue along these lines in terms of GDP and what we produce in real goods and services in the in terms of the economy. So the most expedient and fastest way to usually take care of this kind of situation historically is to have the reserve currency really devalue. in real purchasing power in nominal terms. So we're probably staring at a super cycle in commodities this decade and the next. And also a sophisticated, lot different it's different than the 1970s, of course. We have a lot different demographics. People are aging. We have technology obviously pushing on the deflationary side. And then we also have forces that are pushing on the monetary side to consolidate the banking system, right? I mean, if you were going to create a central bank digital currency and have the banks just in the center of between them all, we're just going to have further consolidation of the banking system. If you look at the banking system in the last 10 to 20 years, we've gone from having just over 10,000 banks and thrifts to now like 5,000 banks and thrifts. Every time the banks, offer a merger, the Federal Reserve just greenlights it. They've never said no in the last 20 years. What does that tell you? It tells you they're going to continue consolidating the banking system and gaining more control over it. So now the Federal Reserve and the U.S. Treasury are in charge, and I think ultimately they've told people what they're going to do long term. And when they get pressed, like in 2011, Kyle Bass was running his mouth a lot about gold back then, and he made a poor trade for the University of Texas, and paid for that, I think, in terms of reputation. But he did say a lot of things out loud in 2011 that were pretty interesting. And one of his things that he said that were really interesting was the fact that he's talking to higher up in the Treasury for the Obama administration, and he's pushing this guy and saying, like, how are we going to pay off all these unfunded liabilities if we're not going to have nominal wage deflation, if we're not going to somehow get more competitive with our foreign trading partners like China and others? And the guy gets pressed and he's like, well, we're going to export our way out of this. And it's like, well, I mean, how are we going to do that if you don't ruin this, the salaries and pay them dirt? He's like, we're just going to devalue the dollar, essentially. We're going to kill the dollar. I mean, that's the easiest way, right? And so I know that in the short term, the dollar's holding up well versus all these commodity currencies, et cetera. And all these currencies, everybody's blowing out their monetary basis. So what we're staring at is essentially a big inflation coming for all fiat currencies. And the dollar, if the system starts changing, right? If the idea that the dollar backs, 60% of the reserves that are held by governments, if that is changing. You see a lot of these governments going, they're going out and they're buying gold, they're buying yuan, some of these countries, for preparing for potentially doing more trades directly with yuan without dollars in between. The euro will probably gain a little bit further exposure, I assume, as time goes along. So and there's going to be a lot of changes technologically, and the system's not going to be, I just think we've talked last time about how the SDR is probably coming in an MSDR system, a new bond system that will kind of supplant the U.S. Treasury market as being dominator of things to come in the next few decades. So there's a lot of changes and they're big things. So it's not like it's happening tomorrow, but I'm looking out 5-10 years with this trade, and I'm not trying to make a quick buck on it. I'm more thinking in terms of,
capital preservation.
Yeah, of course.
Right.
That's the key first and foremost in terms of, and you can swing trade it for sure. I mean, obviously you can keep a certain percentage to do short-term trades on it, but I mean, for the majority of it, it's much more of a prudent, position that you don't really you don't trade much. You just kind of keep it there for capital preservation.
Does this mean anything to you, James? With the yuan finally kind of turning the corner after being in a downtrend for a while? Implications, is that normally, I think the correlation has changed on and off. I think when USD yuan used to go up, it was kind of negative for the gold.
Mm-hmm.
And wasn't it? I mean, correct me if I'm wrong. I'm just guessing, but the correlation, I think, means more risk off, even though it's a real managed currency. I'm just wondering, when you look at this is short term, but you look at the weekly, this thing may be bottoming. Does it have any kind of implications? And
for sure. Okay. If China goes out and starts devaluing the yuan versus the US dollar, it's going to throw it'll be an issue in terms of the system for sure. I mean, China, if you sit down and look at China, like obviously they don't have like a bond market that's anywhere near the size of the United States. They don't have the ability for people to move capital in and out very, very seamlessly. So they don't have an open capital account. I mean, it's not going. It's
not the U.S.
No, and that's why the U.S. dominates the financial system. But China knows that they have to play ball in order to get some sway in this, and they're obviously. I mean, I was just looking the other day. There was you probably saw it on Twitter. There was a graph that went around that showed the world's largest trading partners from 2000 to now 2020. The graph in 2000 was virtually all blue. Only, China's near neighbors were beating the United States in terms of being the major trading partner. And now it's reversed. It's virtually all red. I mean, only Mexico and Canada and like Colombia. That's it. That's all. We're the only ones. Those are the only countries that we are the number one trading partner with now. Everywhere else is just red. China, right? So in the longer term, they're going to figure out a way to get involved, probably with the IMF. I'm assuming they'll use that as their stopgap. They'll probably be involved because they're already involved with the SDR. The yuan is part of it. So I'm guessing in the MSDR, the yuan's going to be involved. The question, I guess, for me all the time is I've heard people looking at the numbers and saying, like, obviously 6.5 yuan to the US dollar. When they look at the trade flows and how things are, that they think it should be much higher than that, in terms of yuan should be devalued by a huge percentage, like going back to 10, 20 even sometimes, I've heard people say. So if the yuan devalues, I mean, that's going to be in some type of really big manner like that will throw everything off. That'll be a catastrophe, that'll be a big event in terms of
well, I mean, they are having problems in Asia. Equity prices are under a lot of pressure.
Yeah, right. And I've seen that they're raising.
They look the opposite of U.S. and European markets.
Yeah, but I mean, let's be honest. The U.S. market's not financially healthy. It looks like obviously it's going straight up a wall of late in terms of the stock market and such. But the fundamentals of it, obviously, someday that'll matter. And when it does, you could pump all the currency you want into it. It'll still be a problem. I don't think it'll perform all that great versus other real things. So we'll see in the short term. Commodities have shown a little bit of weakness, but I think that's the short term, and more in the medium and longer term, they'll come screaming back. You have a situation where people like to pinpoint and look, lumber and steel are crashing. And it's like, okay,
right.
Well, I mean, I'm trying to think of what the latest one. Oh yeah. And there's coffee all of a sudden going up a wall. And, you start thinking about how much you get charged for some ridiculous cup of coffee at Starbucks, and just think in the future, that's going to be like $9. You think $4 or $5 is much for a coffee. It's like,
yeah,
they'll be serving you Robusto beans, not our Arabica beans. I mean, the price of goods and services in the future is going to go up. I think we're not investing enough in terms of, making the supply and demand factor meet at a better price or an equilibrium. I think we've neglected a lot of that stuff in the last 10 years. So you're going to have a situation where oil is going to be high. There's not going to be as much oil as there once was. A situation where a lot of these commodities become a little bit more precious and scarce, and people still want
water. How about water there, James?
Of course. And they telegraphed that for like a decade or two, and they're different.
Yeah.
The powers that be love to tell you that we are polluting the earth, and we're like, humans are like basically a virus, and they like to tell us that someday there'll be a problem with fresh water, and they'll tell you in a decade or two in advance. And yeah, that's true. I mean, in terms of a lot of places will have water wars, I think, in the coming decade or two. A lot of countries will have wars over water.
That's biblical. I mean, it used to happen.
Oh,
right?
Yeah, I know. Over resources, over in order to keep your population and your farms going. Yeah, of course, people are going to battle over that, because if you don't, they're gonna have a coup on you, and you're gonna lose your head. So, yes, of course. I mean, that's a real thing, and it's already been projected. There's a lot of people thinking in the next decade or two that you're going to see a lot of water wars, especially other sides of the country. But
yeah,
I mean, it's
definitely an issue.
Yeah, but Dale, I think we should financialize it and create futures for it. I think that would be the smart thing, because that would save the world, right? I mean, no, I'm kidding around, obviously, but I mean, it's like everything needs to be financed. Can we financialize oxygen? Can we financialize what else do we need to live? Sun.
Make an NFT of a cup of water and sell it for $1 million. I wanted to ask you if you have a view. In the last several weeks, we kind of broke out in the gold silver ratio over the 68.5 level. Mm-hmm. And it still looks like it has some upside here. I mean, I guess you could call it a bear market rally from where it came from. But does this have any implications turning back to the upside as it did? I mean, the implications of this were pretty obvious that, silver was way undervalued here. and now we're getting a little turn in the market. You still,
Yeah, no,
and I know does it have to do with Reddit's short squeeze in silver, and that's why
we can talk about that for sure. I think
Yeah.
the Reddit thing it's more about noise on the channel in terms of making noise on the social media screens and the algorithms picking it up, and the larger traders using that as cover to I would think to coordinate and go long as well. But they have not yet done that. I mean, we're not even. I think right now
they're talking $1,000 silver.
No, obviously that sounds ridiculous, and it's easy to like laugh with someone when they say something that crazy. It sounds like, I mean, if I just look at silver right now, you're at $25. You could easily make a case for 3-digit silver, a couple $100 silver. You know, if someone says $1,000, if you say 1,000-ounce silver, that basically means like, oh, the currency's hyperinflating. Really, I mean, that's basically what the listener thinks. So, because they don't know the history of this metal and how long.
Don't you think they're going to learn it's different to try and do a short squeeze? AMC is different than a global commodity market.
Well, it's different in terms of the size and scale.
Yeah, that's what I mean. Yeah,
of course.
I think I heard yesterday from someone the average Reddit account was about $300 to $500, mainly stimulus check money.
No, I think that might have been the case for some of those AMC traders who are on Robinhood. And that is the case too for a lot of these Redditors who are in the Wall Street Silver Reddit forum. There's a lot of small guys, kids in their 20s who, they can afford a tube of silver a month or something like that. But then there's also middle-aged, middle-aged people who have a decent net worth who are taking, deliveries of closets full of silver, of, safes full of silver. So there's a lot of people out there who are pretty aggressive on how much silver they're buying and taking delivery of and anonymously sharing through Reddit forums. I mean, there's a picture every day of some crazy stack that someone just got. So it's real, and I think it will grow. It's at 125,000 users right now. When things get hot, if you see silver move upward in spot, you see gold move up in spot quickly. Those could double within a matter of weeks. You could have 250,000 people on that forum, and then you could have 500,000 in that forum. That happens very quickly in terms of, the GMC phenomenon. It went probably sideways for a little bit or didn't grow that great. And then all of a sudden it gets some price action moving forward, and you get a little bit of press coverage, and every hot, momentum trader starts looking around, thinking about what's the next thing they want to put their money in. And you all of a sudden get a huge gap up in terms of people involved. So we all know, Dale, that like the large capital flows that are really going to move gold and silver are going to be the institutions and the high net worth investors, mainly from the West. But also there's a lot of Easterners now who are really wealthy in China, et cetera.
Yeah.
And the percentage allocations, and I've done the research. Let me see if I can finally share my screen and show this.
Okay, I'll stop sharing.
Nah, this thing, next time maybe. It's giving me this thing where I got to go in the preferences, and that's deadly for people who are even listening. So we're just gonna keep talking through this. On my Twitter feed, I have, if you go to @JamesHenryAnn, you can just run down my Twitter feed, and I think I tweeted yesterday about how truly tiny. In terms of, it was an interview of the top 150 family, not top 150, but 150 family offices by Goldman Sachs.
Okay.
Yeah. And you can see a whole bunch of, there's a subtweet underneath that one. If you click that one will show you a tweet about how truly tiny in terms of, the percentage allocations that are being involved with bullion and precious metals. So there's different reports out there. There's one that's done by Credit Suisse, and there's also one that's done by Frank Knight Templeton. I think Frank Knight is called. Frank Knight has a report every year about where they interview various family offices and high net worth investors, and they get an idea of what percentage are allocated to what. Precious metals is like slim percentage. Like the highest is in India, and it's maybe 6% of people's net worth is in precious metals. And then, North America is like 2%, 3%, very tiny. And when you look at gold in terms of where, as far as, throughout all investments that are on paper, it's still less than 1%. It's like at 0.7%. I mean, if we go back toward 2011 levels, it's going to be much higher in terms of the price. But if we go back anywhere near the 1980 levels, if we have a real concern about the fiat currency underlying, you know, what its real purchasing power is, as we did in the 70s, I mean, the potential for gold to gap 3-4 times is there.
Where was it? Where was participation rates back then? I was in the business then when gold went to 880, and you had the hunt squeeze at 50 bucks.
Sure. So there's a graph that shows if, you know, in 1980, in terms of investable gold as a percentage of global financial assets, it was just under 3. And right now, you know, 2020, it's 0.7. So you're talking about
triple.
Yeah, tripling. Oh, what's
quadruple.
that? Quadrupling, actually. I mean, and you get to that point, you have $8,000 gold, which if you do that, that's just a repetition of history, you know, happening again. That happened in 1934, where the U.S. official gold reserves backed 40% of the monetary base. And same in 1980, it was much higher. It got over 100%. We could have gone back on a literal gold standard in 1980, 81. And then now that's the assumption, is that gold at this point, the amount of currency that's created right now, it needs to be around $8,000 for that to repeat. And I'm pretty confident we're going to go through that. I just don't know, obviously, the machinations. No one for sure, unless omniscience, I guess, might know. But I do think
so. The AK is based on dollar circulation.
Yeah, it's based on monetary base, M0, fiat monetary base, M0. And Fred has a chart for that. I mean, you can look that up, and if you look at it, you'll see on a percentage basis, it's almost up 100% since, you know, the end of 2019, when the repo fiasco began. Before the COVID thing started, they were printing. So,
you know what? Since you brought that up, what's your take on? I think Wells Fargo was the first one to pull in personal credit lines, and other banks are doing it not because they have a liquidity problem. The liquidity problem is they have too much liquidity that they can't keep on their books due to regulation. What are you thinking about this?
Yeah, that's hard to say. I mean, it's hard to make a guess on that. I mean, I saw
why are they pulling credit lines? Last time they did that was, you know, after the crash in 2008.
Right. And if you look at the prices of housing right now, we're in a larger financial bubble now than we were then. So, I would imagine that would be a specific, I think it was a specific loan that was based off your house, right? It was like a secondary loan where you're using your house as collateral for that loan up to $100,000. It's probably a lot better of a way to use credit than, say, credit cards, especially if you're somebody who is not paying off a credit card every month fully, right?
Right.
So yeah, I'm imagining that they were concerned. I don't know enough about Wells Fargo's books. I don't know enough about it to make an educated.
It's happening in Canada. I talked to a trader friend of mine.
Of course,
he's in Toronto, and it's happening there too. Just wondering if you.
Canada obviously is in a crazier situation. How fast and how high their bubble has gone up in terms of Vancouver and Toronto. And, all the other all the other cities there. It's still.
How about Panama? Is Panama real estate in a bubble too?
No, Panama's still cheap. It's not super dirt cheap, but it's not expensive either. It's kind of in the middle right now.
Okay.
I look around at prices, and most people are asking more than it's worth, but that's to be figured, because most of these people who are selling it are typically are boomers that are winding down and getting ready to go back to the United States and pass away. So they want to liquidate their prime real estate, and usually they're doing it at a price that's pretty high. So they're going to have to get lucky to find someone to buy it. And I just look out at this place and I think, okay, the next 10 years there'll be an equilibrium that's met between some offshore, expats who want to live here in this town and work online, et cetera, versus the baby boomer gringos that are going to be passing away in the next 10, 20 years here. And they're the people who inherit that stuff and come down and liquidate it. And then you also have a population of people who are coming in from Colombia or who want a secondary home, a place to park money. The same with Panama City. So you have mostly Panama City people who come in here to buy that kind of stuff, who want a little secondary country house. So there'll be a meeting of where the supply and demand is, but I think it'll be lower in terms of real value.
How about the real estate bubbles in the U.S. and Canada?
I mean, how about that? Dale, I would never thought we would have gone past 2008 again so quickly.
Me either. So
the lesson in history is that things repeat and rhyme all the time. So I saw yesterday somebody's talking about a 40-year mortgage, and they're thinking about doing that for homes. And that makes sense. You can't have BlackRock and Blackstone buy up every damn house in the world. Eventually, people are going to have to actually take care of the properties themselves. Could you imagine, Blackstone or BlackRock and their subsidiaries as your
landlord?
Yeah. I mean, could you imagine how terrible they would be? I mean, that would be bad. So coming up with a way where people can actually own a home and pay a price that's stretched out way far in the distance and that has an interest rate that's locked in for 40 years, at least hopefully neighborhoods won't fall apart in disrepair. That's the problem, is a lot of these neighborhoods could fall apart in somewhat disrepair. And that's already happened. We see a lot of blight, especially in places in the Midwest and Rust Belt, et cetera. So you don't want to see that. You don't want to see that happen in the West Coast and places where the homes could easily happen. It could fall in disrepair in a lot of these cities, and you don't want to see that happen.
Okay, James, any last thought you want to share about what's happening here and going into the dog days of summer? Go ahead.
I mean, precious metals certainly have, I think, the potential to trade a little bit lower, but not a big amount, and they're not going to be going back down to prices that they were before the lows last year, and so that's just not going to happen. Not with what we've done to the monetary base. So you could, in the short term, you could see some weakness because we have, a little bit of a lull in the interest that is happening. But I think come September, October, November, there should be a resurgence in the prices. Before the end of the year, I think we're going to have gold near a new record high again, and they're going to have silver running back toward 30s. Hold on one second. Got a car going by.
Okay. We good?
Okay.
All right.
No problem. Sorry, I'm sitting out in my backyard.
Yeah.
And a truck goes by.
All right. Well, okay. And let me ask you this. What's a typical delivery time? I know you're a physical metal broker. Let's say I wanted to buy, 20 ounces of gold and I wired you money today. When would I have it?
If you wired good funds, you'd have it within 2 weeks. You'd have it within 1 week for gold. Within silver, it would probably be about 2 weeks.
Because supply constraints still?
Yeah, there's still supply constraints in terms of meeting the demand that's outstanding. It's slowing down. It's getting better. The premiums are getting tighter on both sides, but that's still the case.
Okay. All right. So if you want to add to your portfolio of physical metals, James would be a good representative for you. And, the name of the company that you do it through, James?
Yeah, it's sdbullion.com. We're a top 5 retailer in the United States.
I get emails from them all the time, but when I'm going to add to my portfolio, I'm going to call you.
Appreciate it, Dale.
All right, buddy. So thank you very much for, joining us today from the Southern Hemisphere. And how's Panama doing in the Olympics? They have any representatives there?
I don't believe so. Otherwise, I would have heard of
it. All right. All right, buddy. Don't get caught in the canal, all right?
All right, Dale.
All right, James. That's a wrap, everyone. You have a great trading day. Gold is coming back, as James talked, but the gold-silver ratio still going up in gold's favor. And we'll see everyone tomorrow. You're welcome. And remember, don't just count your coins, your bars, your bags, count your blessings. Adios, everyone. Take it easy. Thanks again, James.
Yeah, thank you. Sorry about the non-share screen. Next time,
That's okay.
I'll have to figure it out, because I was ready. I had a whole bunch of charts to show.
All right. Well, now you're going to have another 3-4 months to get ready for it. All right, buddy. Have a good summer, buddy.
All right, you too, buddy.
See ya.